Hello traders, you are welcome back to the Forex Geek channel, and I especially welcome you to this video. Now, if you are new here, don't forget to hit that subscribe button and turn on notifications so you never miss our latest trading tips and strategies. All right. So today we are diving into a powerful yet simple concept that can transform your trading journey. All right. So basically we are going to be looking at the EMA Pullback Strategy. All right. Strategy. So this is what we're going to be looking at today. So this strategy is particularly beginner friendly. So if you are just starting out, then you are in the right place. The Forex Geek channel is for you. So let us start by breaking down what an EMA is. Okay, EMA stands for exponential moving average. Unlike the simple moving average, which treats all past prices equally, the EMA gives more weight to the most recent prices. Okay? This makes it more responsive to new information, which is essential for trading. Now, why is it important? Why is this important? In the fast-paced world of Forex trading, having a tool that reacts quickly to price changes can give you a significant edge. Okay? It can give you a significant edge. Exponential moving averages help traders identify trends and potential reversals. Okay? The main idea behind using the EMA in a pullback strategy is to enter the market during a temporary price correction, allowing you to capitalize on the overall trend direction. Okay? Now, before we get into the actual strategy, let us quickly talk about how to set up the EMA on your trading chart. Okay? Now, most trading platforms make this very easy. Simply look for the indicators section and select exponential moving average. Okay, so we're going to come to insert indicators moving average. Now, this is the MetaTrader 4 platform. Okay, so when you have selected moving average, make sure the MA method is set to exponential. All right. Then for this particular strategy, I'm going to recommend using two exponential moving averages, a shorter one like the 9 EMA, all right, set the period to 9, and a longer one like the 21 EMA, set the period to 21. Okay, I'm just going to change the color for easy identification. All right. Now, the shorter EMA reacts faster to price changes, while the longer EMA gives you a clearer picture of the overall trend. Okay, once you have added this to your chart, you will want to observe how they interact with the price. All right, the key is to look for pullbacks to the EMA during an established trend. So, for example, we can see that we need to watch out for smoother trends. All right, smoother trends that have a more steep slope. Okay, such as this one. So and this, you can see this, you can see this, you can see this, you can see this. All right. So basically, what you want to be looking out for is pullbacks of price towards the EMA. So for example, we can see that this is obviously a bullish trend, all right, because price was consistently going up, okay, recording higher highs and higher lows. All right, so what we have to watch out for is when price comes back to touch the EMA right after the pullback, then you can enter a trade, all right, in the direction of the trend. Okay, So how do you identify a trend? A trend can be bullish or bearish. A bullish trend is characterized by higher highs and higher lows, just as we can see here. Okay, we have higher highs. The new highs are higher than the previous highs, and the new lows are higher than the previous lows. Okay, while a bearish trend features lower highs and lower lows. So let's just look for a bearish trend quickly. So we can see we had a bearish trend here, lower highs and lower lows. All right. So to determine the trend direction, just simply look at the position of the two EMAs. If the 9 period EMA is above the 21, remember that our 9 period EMA is this crimson color. So if it is above the 21, for example, like in this situation, you are likely in a bullish trend. Conversely, if the 9 period EMA is below the 21 period EMA, as in this situation, it indicates a bearish trend. So once you have established the trend, you are ready to look for pullbacks. All right. Now here's where the magic happens: spotting pullbacks. A pullback occurs when the price temporarily moves against the trend. Like we can see, this is a bearish trend. So when we have a bullish move, that's a pullback. When we have a bullish move, that's a pullback. Okay. All right. So when you notice a pullback, look for confirmation signals. This could be a candlestick pattern, such as a pin bar or engulfing pattern that suggests the price is reversing back in the direction of the trend. Okay. For example, if you are in a bearish trend like this, and then you notice perhaps let us say, okay, you notice something like an evening star. You can see we had somewhat like an evening star. We had an evening star here. So if you notice any bearish candlestick pattern in a bearish trend, just right after the price has bounced off the moving average or within that moving average zone, then it can be a sign that the pullback has ended. So you can just enter a sell. All right. And then you can set your stop loss above the resistance or above the swing high. And then you you set your take profits at the nearest support zone. All right, set at the nearest support zone, or you can just exit your sell trade when you notice the 9 EMA crossing above the 21 EMA. Okay, so the bullish crossover can be your exit signal for the sell trade, or you can just set your stop loss at above the swing high and then take profit at the nearest support zone. Okay, then the reverse is the case for a bullish trade. All right, now let us talk about risk to reward ratio. Okay, it is important that you always observe good risk to reward ratios. All right, meaning, for example, if you are risking $1, you should be targeting at least $2. That's the risk to reward ratio of 1 to 2. Okay, it's important to have good risk to reward ratios so that in the long run, even if you have equal number of wins and losses, you are still going to be on the winning side. Okay, so this strategy helps ensure that your profitable trades outweigh your losses over time. Now, before we wrap up, let's discuss the importance of risk management. No trading strategy is foolproof, and that's why you must never risk more than a small percentage of your trading account on any single trade. Okay, this protects your capital and allows you to continue trading even after a few losses. I also highly recommend practicing this strategy on a demo account before diving into live trading. This gives you the opportunity to test the EMA pullback strategy without any financial risk, helping you to get comfortable with the mechanics and build your confidence. All right, traders, that wraps up our deep dive into the EMA pullback strategy. I hope you found this information helpful and that you feel more equipped to implement this strategy in your trading. Remember, practice makes perfect. If you enjoyed this video, please give it a thumbs up and leave a comment below sharing your thoughts or experiences with the EMA pullback strategy. Don't forget to subscribe to the channel for more trading insights and tips. Happy trading, and I'll see you in the next video.